Hi, everyone. It's David Barnett here again for another one of our Lunch and Learn events here at ALP Valuation Services. Today, we're going to be talking about the methods of equipment valuation. And this is going to be a quick video, but I hope you take a lot out of it. So, there are three different methods for determining the value of machinery and equipment: the cost approach, market data, and income approach. And if you've ever looked at any other kind of appraisal document, such as a commercial property appraisal, you've probably seen a discussion in that report about these three different methodologies. And we're going to compare how someone like a real estate appraiser might apply these methodologies versus what we do in the world of machinery and equipment. So, first of all, the cost approach. This is based on the concept of substitution. We basically have to ask ourselves, at what price does it make sense to buy this used item versus going and buying a brand new piece of equipment? Now, over the course of time, in the world of appraisal, we have been able to develop depreciation schedules, which are have been vetted and verified via market data to demonstrate what amount of sort of expense for wearing out or what this substitution comparison should be based on the class of equipment. So this would mean, for example, that a truck would depreciate more quickly than, say, a silo for storing some kind of liquid, which doesn't have a lot of moving parts, etc. So different types of equipment are classified into different categories, and we have different depreciation tables for each one. Um, we're always concerned with what is new or what the price of something new is going to be. So if you imagine if you were trying to figure out the value of a car or you were looking at a used car, you would be asking yourself, how does this compare with something that is new? You would not necessarily be concerned about what the person who is trying to sell the used car had paid for it, right? And so with the idea of a car, it's really easy to sometimes look at what they paid for it because cars don't live that long. But when you get into equipment that might be around and productive for decades, it can be very interesting because what they paid 30 years ago for the piece of equipment really has no impact at all on what that piece of equipment is worth today. So we're not talking about depreciation or book value, something that an accountant might calculate for the purposes of someone's balance sheet or tax returns or something like that. We're always looking at what is new and what would someone pay for the used piece of equipment. I'm going to give you an example here as we move along. The direct market data approach is based upon the idea of market efficiency. So, what we're trying to do in this case is we're trying to understand what other people are willing to pay for that piece of equipment. And we do that by going out and looking for sources of information. But we have to modify our search in a certain way or the results of our search because we need to understand where the market is. I'm talking about the physical location of a market. So let me give you a couple of examples. If you were in a small town in New Brunswick and you were looking at a piece of equipment, let's say in a commercial kitchen, where is the market for commercial kitchen equipment in New Brunswick? Well, it's probably not in the small town. There's not a lot of buying and selling of that kind of stuff in the small town. We'd probably be looking at one of the bigger centers, Moncton, for example. And so when we appraise that piece of equipment in the small town, we're going to be taking into account the transportation costs of moving it from the small town to the market. So in a small community, something may actually hold a little bit less value than it might in the bigger center, because if you ever had to sell or liquidate the piece of equipment in the small town, you'd be burdened with the costs of transportation. You can observe this yourself. If you ever go looking to buy something, you might say, hey, this piece of equipment seems to be more expensive here in the Maritimes than it is, for example, in Montreal or down in Boston. And what you are observing is you're observing the sort of location differential. The same thing is observed in commodity markets, with wheat or pork bellies or anything like that. The further you get from the place where the commodity is traded, for example, the Chicago Mercantile Exchange, the greater the difference in price is actually going to be, sort of the farm gate price versus the market price. We also need to observe, we have to have an understanding of what type of value we're observing. So, for example, we could be going out and talking to several different kinds of market participants. So we could talk with an auctioneer who might tell us that they just sold a certain piece of equipment for $3,000. We could talk with a dealer who says that they just bought a piece of equipment from another business and they paid $6,000 for the same piece of equipment that the auctioneer just sold. And we could use both of those pieces of survey information to determine that the fair market value in continued use of that piece of equipment already sitting in a business and productive might be $10,000. Because what we observed from the auctioneer was a forced liquidation value, and what we gathered from talking with the dealer is an orderly liquidation value. So we always have to be cognizant of these things. And so sometimes we'll go into a business to do an appraisal, and the business owner will say to us, I bought some of this stuff at an auction, and they're concerned that they think it's worth more than what they paid. And if we're doing a fair market value appraisal, in fact, our report will often be far more than what they paid because of the circumstances of the transaction that they participated in to acquire that piece of equipment. The income approach. Now, in a commercial property appraisal, the income approach is really important because real estate appraisers are keeping track of cap rates in a given market, what sort of rate of return investors are going to demand, because they're really evaluating the cash flow that should be coming out of that piece of property. In the world of equipment and machinery, it is extremely, extremely difficult to attach a specific cash flow to any kind of piece of equipment. And so, as such, it's very rarely used. There are a few examples that I've been shown from my time through different training that I've done in this space of things like pipelines and stuff like that, where you could say, yeah, this entire pipeline apparatus from one place to another yields a certain revenue for the company that owns it, and so then you can extrapolate from that income, what this thing is worth. But really, it's very theoretical, and we are almost always using um, the cost approach or the market value. Let me show you an example of how this works. So here is a post that I put on LinkedIn where I asked people about this piece of equipment. I said, what is it and what do you think it's worth? And we got a bunch of different bits of feedback from people. And so this was an elite brand 13-inch semi-automatic horizontal bandsaw model UE330SSAV. And so this is used in a machine shop and it's used for metalworking. We appraised this for a bank in 2013. So it was over 10 years ago that we appraised this from the time I posted that thing on LinkedIn in 2024. We determined that it had an effective age of 7 years at that time. So there's the actual age of a piece of equipment, and then there's what we call effective age. So what can have an impact on effective age? Well, it could be things like a piece of equipment that's rarely used, could be 10 years old, but we might say, hey, because it's so rarely used and it doesn't have a lot of hours on it, for example, we might say we're going to appraise it as though it were younger than it really is, because it doesn't have the same degree of wear and tear as a piece of equipment that is 10 years old. If a piece of equipment has had some updates, a new motor installed, for example, or something like that, then that would be another reason for us to reduce the effective age. The replacement cost for this piece of equipment back in 2013 was about $10,000. So, based on this information and based on looking at market values that we were able to observe, we determined at the time that this piece of equipment in 2013 had a fair market value in continued use of $6,700. So, what about today? Let's take a look. So, remember, 2013 fair market value was $6,700. What do we do next? If we were to go back and appraise the very same piece of equipment in the summer of 2024 and found that it was still in good condition, even though it was 10 years older, it would appraise for $5,600. So this begs the question, how can it be 10 years older, but only quote unquote worth 16% less? Well, in fact, it's worth a lot less than it was back then. And here's why the number, though, appears to only be 16% less. First of all, we're always comparing with new. And so the price of a brand new 13-inch bandsaw in 2024 is far more than $10,000, right? So the comparison is with something that has a much higher value than what we were comparing it with 10 years ago. Here's another one that we have to think about all the time, but most people don't consider. We're measuring the value of this machine in Canadian dollars, and every year with inflation, those Canadian dollars become worth less. So $6,700 in 2013 held a lot more value than $5,600 in 2024. The last part, because we're talking about fair market value in continued use, we have to also consider the freight and labor installation, delivery charges, et cetera, that went into getting this piece of equipment into that shop, wired into the panel, the setup and commissioning of the equipment, making sure it's perfectly level, all that kind of stuff. And all of those things are more expensive in 2024 than they were back in 2013. So these are all the factors that kind of lead into um, you know, determining the value. And this is an example of how really there's no comparison at all between what the appraisal value outcome is and, for example, the book value that would be calculated in an accounting fashion by depreciating the purchase price of the piece of equipment. If this were being depreciated um, using a declining balance method, it would probably have almost no value at this point. But clearly, if it's doing work, it is definitely worth something to the business and would hold some value for anyone that wanted to buy the piece of equipment or buy the business and use the piece of equipment for collateral. So, so when are these methodologies used? Number one, the market method is the preferred method. Every time we can, we're going to always try to go to the market and see what people are really paying for the piece of equipment out there. Um, but sometimes you can't observe a market. So we have to look at the cost. So why, for example, would you not be able to observe a market? Well, it could be that there's very few of these items out there, that they just don't change hands as often. It could also be that certain kinds of equipment are almost never put up for sale. I once appraised a processing and cooling tunnel at a fish cannery, and they had a pretty new piece of equipment. And then the owner of the facility brought me outside to an old shipping container, and inside of that was the old cooling tunnel. And he wanted that one appraised as well. And so, why was the old cooling tunnel still there? Several really logical business reasons. Number one, it was there as a backup if they ever needed to. Number two, it could be used as a second line if they ever had a capacity problem. Or number three, he didn't want to sell it because if he sold it as a used piece of equipment, he could potentially be putting a new competitor into the market. And he didn't want to help anyone else get into the market. That wouldn't serve his purpose. So it would never be put up for sale. And there are all kinds of examples of highly specialized pieces of equipment that exist within manufacturing facilities in the region that are never going to be put up for sale unless maybe the business were to close and stuff would be auctioned off. We've also got equipment that is custom made or equipment that is homemade. And so these can be one-off pieces of equipment that just don't really have a comparison out there. And so when we look at this kind of stuff, we have to often build up a case of what we think it might logically cost to replace the item today. And then we have to use that as our cost basis for then creating our depreciated cost approach valuation. So if you would like to learn more about machinery and equipment appraisal, join our email list and you'll get a copy of our special report, The Essentials of Machinery and Equipment Appraisal. Certain professionals, we also have other supplemental reports that we send out as well. You'll get notified of any new videos if you join the email list. We only send out one email every month. Unless there's something special going on, like a trade show or a conference or something that we're going to be at, we might send out a notice for that. If you go to the website, you can find all kinds of videos answering different questions about frequently asked questions that we've received over the years, and reveal more information about the process and the value behind having a certified USPAP compliant machinery and equipment appraisal. And with that, I'll invite you to come over to the website, BusinessAndAssetValues.com, or pick up the phone and call us with your questions. We're more than happy to talk with you and see if we can be able to help out you or your clients. Thank you very much.